So basically, the company experienced net losses almost every period since its inception in 2009, and this is what they stated in their annual report. And if you look at the chart, so if you look at 2021, the EBITDA turned to negative. The reason including high discount and low profitability due to unfavorable product mix due to Beyond Meat jerky and the inflation headwind for the logistics and the manufacturing material. And when you go to look at the 2025, there is a big gap between the EBITDA and the net loss. The reason is that the company recorded the $77 million in impairment loss, reflecting they foresee inability to fully utilize the machine capability. And that means the production from machine is not sufficient to cover the lease payment from those machines. And this impairment recognition is trigger a law firm to begin an investigation because the law firm believed the Beyond Meat made mislead statement to investors. Unfortunately, the Beyond Meat also involved in another lawsuit. A company called Philadelphia Food sued Beyond Meat for the trademark infringement.
What was the infringement? Sorry to bother. What was the basis of their lawsuit?
So Beyond Meat have a campaign with the Dunkin' Donuts, and their slogan is "Great Taste for plant-based." And the vegetarian food also have a registered slogan called "The best taste, the great taste in plant-based." So it's almost the same slogan. So the potential settlement is $39 million.
But they didn't pay.
They did not pay. They plan to appeal, but their campaign partner Dunkin' Donuts already done the settlement with the vegetarian. So as a result, I believe the chance for Beyond Meat to win the lawsuit is very low. And they need to record the litigation reserve and hit their P&L again.
Wow. That, like, if they had paid that, that's potentially sinking them, right?
Yes. Yes. So they want to turn around, but they still have additional litigation risk.
Do you think the juice is worth the squeeze?
You guys know.
Okay.
Can you try that?
Okay, so they did some operational restructure. So in 2024, their gross margin turned to the positive. The action included increased price, reduced discounts, and consolidate production network and the logistics savings. And they also reduced the headcounts to lower their SG&A by 22%. But even though their overhead was still high and their gross margin is very steep, so the company still have net losses and burned cash. And their restructure activity also reduced the cash outflow. So they improved the inventory management to narrow the operating cash outflow. And they stopped purchasing equipment. They changed to leasing it. So the investment cash outflow is low. But even with those restructure activity, they still burn cash. So if we look at the Beyond Meat from the investment market perspective, you will see their stock price still decrease. It's not rebound in 2024. That means the investor did not buy into their turnaround strategy. And they, in the current quarter, they have significant activity here. They issue the new shares. Primarily is used to for the debt to equity exchange, but they also sell a small portion to the market, so they get the 149 million cash inflow this year. So, but the overall, this caused a significant dilution is around 5.9 times compared with the September, significantly hurting the legacy shareholders. So let's go to see the scenario analysis. First is the 30-week cash flow forecast. I incorporate the key factor here, including the liquidation flow of the $50 million not requested by the new debt package this year. And I also include a potential trademark settlement, 39 million here. So if you look the gray line, there is no new cash injection. We assume the BYND will be bankruptcy by end of this year. But however, they get the new cash injection of 149 million. So currently they are safe. They do not have immediate bankruptcy risk. But however, I assume their cash outflow for 1 year is around 110 million to 140 million. So we expect the BYND have 1 year for turnaround. And if they cannot do it, they will have the bankruptcy by end of 2026. This is the liquidation valuation. And I break down the inventory and the PP&E into the detail. For the inventory, I assume the raw material and finished goods. The recovery rate is 10% to 15%. For the PP&E, I assume the manufacturer, R&D, equipment, vehicle, the recovery rate is 10% to 30%. Land and the building recovery rate is 60% to 80%. And the rest, the PP&E, I assume no value. I also add on there the new cash injection in 4 quarters. So the overall recoverable asset in 4 quarters is 314 to 378. And if we compare with their liability, first, so overall, the first thing, the turnaround will be 100% recover. The second then, the new note due 2030 have the 70 to 100% recovery, but for the unsecured, it almost no value. And I also try to see the market price for the new note. And you can see the price range from the 78 to 100 is almost consistent with our liquidation valuation. So we think the market is valued from the liquidity basis. And I will turn to the Steve. One.
Steve too.
Steve. Oh, she did say one. We know what's up. All right. Whoever tried the burgers, let's see. We had blue and green. Who preferred blue? 2. Who preferred green? Green was beyond. Interesting. We had a very different opinion between the 4 of us. Blue's impossible. Yeah, all right. So interesting. Maybe they'll make it after all. Just kidding. All right. So we came to the conclusion that while the debt is somewhat